It's the evening of January 15th, 2026. Markets are closed, the noise has faded, but if your eyes are on metals tonight, you can feel it, that stillness before the storm. I'm an independent commodities analyst. I've spent 12 years trading these markets and quietly stacking physical silver. I built this channel because I got tired of waiting hours for financial media to catch up to what I was already seeing live on my Bloomberg screen. And honestly, I got sick of AI-run channels recycling fake hype about silver. I use this avatar for one reason: speed. I can deliver the truth faster than anyone. No drama, no filler, just the facts. Tonight, I need to show you something unfolding in real time, something the big networks won't touch because it reveals a system they'd rather keep quiet. Here's the setup. Silver took a beating this morning. At 9:45 a.m. Eastern, it plunged 4%. The kind of sudden drop that wipes out retail stop losses, rattles weak hands, and makes casual investors dump their positions and swear off metals for good. Financial media? They're calling it a routine cool-down in a tired sector. They want you to think it was just small traders getting nervous, that the silver rally is done and you should pivot to tech or bonds or whatever they're promoting this week. But here's what they're hiding. The screen is deceiving you. Because while silver fell 4% at the open, the miners, yes, the real companies pulling silver from the ground, barely blinked. The Silver Miners ETF, ticker SIL, only opened down 1.4%, and by noon, it had nearly recovered all of that drop. Let me say that again. Silver plunged 4%. The miners dropped just 1.4%. That's not weakness, that's strength. That's your first real signal of a bigger reversal building beneath the surface. And here's why that matters. Right now, tonight, we're less than 12 hours from January 16th, the third Friday of the month. Monthly options expiration. OPEX. If you've been in this space long enough, you already know. It's the most volatile day of the quarter for institutional short sellers. It's when billions in derivatives either print massive profits or implode. And there's a reason these mining stocks aren't ripping yet. It's not because they're weak. It's because they're being held down by a very targeted, very expensive anchor. Let me explain what I believe is happening. Miners are being intentionally suppressed to defend massive bank short positions ahead of tomorrow's OPEX. That's the thesis. And over the next few minutes, I'm going to back it up with data, logic, and a hidden mechanism most investors have never even heard of. Here's the core tension. Silver is hovering around $91, but the mining stocks, the very companies producing this metal, are still priced like silver is at $30. This isn't just a lag, this isn't a market delay, this is a structural distortion that defies any rational pricing model. Here's what I'll walk you through. I'll break down the trap of operating leverage. I'll show the math behind why these stocks are ready to snap. And I'll share my personal strategy for the extreme volatility I expect over the next 24 hours. Because here's the fact. In 2025, silver jumped 140%. It was one of the top assets on the planet. And yet the miners, they're just now waking up. This catch-up isn't a maybe. It's a statistical inevitability, and I think it starts tomorrow. So let's dig in. A few hours ago, I was watching my terminal. It was 11:45 a.m. Eastern. Gold was at 46,859, down 0.13%. Silver sat at 91.52, down 0.75%. Small moves. Seemed like normal noise. But if you weren't watching the tape closely this morning, you missed the real story. At exactly 9:45 a.m., silver got crushed, a full 4% wipeout in minutes. The kind of flush that looks like forced selling, that smells like desperation. But this wasn't random. This was a calculated liquidation. It was engineered to trigger a cascade, drop the price hard enough, fast enough, and every stop-loss order just under support levels gets triggered. Those forced sells set off more forced sells. Momentum bots join the party, and suddenly you've got a full-blown liquidation spiral. That's the blueprint. That's how you clear the board and accumulate size at a discount. But here's what caught my attention. While silver tanked 4%, SIL, the mining ETF, only dipped 1.4% at the open, and within an hour, it snapped back hard. By the time I rechecked at 11:45, the miners were showing clear relative strength. If you've traded stocks long enough, you know what that means. Relative strength means the sector is breaking away from the underlying commodity. It means someone is buying the floor. It means smart money is stepping in quietly, while retail panic sells. And when I looked at the chart of that 945 recovery, what I saw was a textbook V-shaped reversal. And I'll tell you this much, that kind of bounce, that's not retail. That's not some kid on Robinhood. That's deep-pocketed coordination. That's institutional defense, which made me ask the obvious question. Why would anyone work this hard to hold silver under $92? The answer comes down to a single financial mechanic that's on the edge of erupting. And to get it, you need to understand a concept called operating leverage. Let me break it down, because this is the linchpin of everything. Operating leverage is the amplifier of profits. It's what happens when your revenue shoots up, but your costs stay mostly locked in. Think of it this way. Say you own a lemonade stand. Each cup costs $1 to make, lemons, sugar, all in. You're selling it for $1.10. That's a 10-cent profit. Now picture a heat wave hits. Demand explodes. You raise your price to $10 a cup, but your costs still $1. Lemons didn't go up 10x, neither did sugar. Your costs are sticky, they lag. Now you're making $9 profit per cup. That's a 9,000% increase in earnings from a 900% price jump. That's the power of operating leverage. And that's exactly what's happening with silver miners right now. Most producers have an all-in sustaining cost, AISC, of about $30 an ounce. That covers everything: labor, fuel, equipment, processing, admin, taxes, permits. Back when silver hovered at $35, they were scraping by. Maybe a 14% margin, tops, survival mode. But now, silver is trading near $91. Let's do the math. Profit margin, price, AISC, price. So at $35 silver and $30 AISC, that's $35, 14%. Now at $90 silver and same $30 AISC, that's $60, $90, or 67%. That's not a small gain, that's a 5x surge in margin. And yet the mining stocks, flat, stalled. It's like they're being held down by invisible weight. That's the distortion, that's the gap. That's why I'm telling you, silver miners are the most mispriced, ignored, high-leverage opportunity in the entire macro space right now. Now, before you accuse me of being another silver permeable high on hopium, let's talk objections. I want to address the legitimate counterpoints and dismantle them. Skeptic claim. 1. AISC is rising fast. Bears say inflation's eating profits. Fuel, wages, gear, all up. So margins haven't expanded as much as bulls claim. My response? Yes, costs have gone up. Diesel isn't cheap. Labor's pricier. Machinery costs more, but they haven't tripled. Silver has. If AISC climbs from $30 to $40, that's a 33% rise, but silver jumping from $35 to $90, that's 157%. That margin growth is showing up clearly in company filings. Read the reports. Miners are generating historic free cash flow. They're cutting debt, boosting dividends, piling up reserves. The data is right there, black and white. Skeptic claim. Number 2, jurisdictional risk. Governments will swoop in, slap windfall taxes on mining profits, and suck out the upside. Classic fear. You buy into a miner in some frontier market, silver spikes, and the government hijacks the profits. Here's my take. That fear? It's the reason these stocks are still cheap. It's priced in. That's why investors prefer physical silver to mining shares. That's why this sector's been ignored for years. But here's what critics overlook. We're not here for long-term dividends. We're not parking cash for a 5% yield. We're here for the violent repricing that hits before the government even drafts the tax bill. Bureaucracies crawl, laws take time, hearings, committees, revisions, months. By the time those windfall tax laws exist, these stocks could already be 2x or 3x higher. That's the window. Now here's something nobody's mentioning. Go pull up the short volume on Hecla Mining, ticker HL. It's at insane levels. This isn't routine hedging. This isn't a measured risk strategy. It's panic. It's someone holding a massive short bet who cannot afford this sector to break out. So what happens next? Tomorrow's the third Friday, January 16th. That means OPEX, options expiration. There's huge open interest stacked at the $90 and $95 strikes. We're talking billions in notional exposure. If silver stays above those strike zones by close tomorrow, some very big players are going to be in serious trouble. Here's my forecast. Expect a brutal tug of war around those levels. You'll see wild swings, fake-outs, whiplash moves that seem random until you zoom out and understand the derivatives game underneath. Here's what I'm watching for. If banks lose their grip on that $90 floor, brace for interference. That could mean a surprise margin hike from the CME. Connectivity issues on key platforms. A well-timed news scare about China or India cutting demand. They have tools. They've done it before. They'll do it again. Because if miners gap up hard, if the separation from silver becomes obvious, then retail jumps in. And every call option sold by the banks starts going deep in the money. That ignites a gamma squeeze, a massive self-fueling buying loop. There's no off switch for that. No hedge that saves them. And here's what really gets me. Silence. Total silence from the mainstream outlets. Nobody's talking about the record earnings due next month. No headlines on the cash flow. No mention of how broken the pricing is between the metal and the miners. This is the accumulation phase. This is when big money loads the truck, quietly, while retail chases the next distraction CNBC throws at them. So here's my radar. This is what I'll be tracking live tomorrow. Number 1, the silver to SIL ratio. If it starts to shrink, if miners start rising faster than silver, that's the breakout signal. Number 2, DXY, the dollar index. If the dollar shows sudden weakness, that's like jet fuel for commodities. It boosts demand from foreign buyers and accelerates momentum in metals like gold and silver. Third on my list, the live action at the $90 silver level. If we hold that line through tomorrow's early session, if buyers keep stepping in every time it's tested, then in my view, the suppression effort has failed. And if the banks lose control, if retail wakes up, if algos flip from short to long, there's no backup plan. That's it. The breakout starts. Let me share my personal strategy. And just to be clear, I'm not here to give you advice. I'm simply outlining how I'm navigating what could be a powder keg based on 12 years of hands-on experience. Here's my signal to scale in. If the mining ETF, SIL, finishes today, January 15th, neutral or in the green while silver itself remains red, I'm adding to my positions. That would tell me the divergence is real, that the breakdown in suppression is underway, that the relative strength earlier wasn't a head fake. It's a precise setup. Silver must stay weak. Miners must stay strong. That's the classic rotation signal before a big upside move. Second, I'm tracking the $91.50 mark on silver with laser focus. That's today's close. That's the key level. If we stay above $91.50 by 1 p.m. tomorrow, right through the OPEC's volatility storm, then I believe the support is real. The banks lose narrative control, and the market's natural direction turns north. But risk management matters. If silver breaks down below $85 during the chaos tomorrow, I'm sidelining. No hero trades, no catching falling knives. I'll wait until Monday's open to see which way the dust settles. Because OPEX isn't just another trading day, it's designed for max pain. Market makers know the playbook. They see every open stop, every strike level, and they'll pin prices where the most contracts expire worthless. That's not tinfoil hat talk. That's how the system works. So I won't fight the chart if the chart is screaming I'm wrong. My target? A rally that takes the mining ETF back toward its 2025 highs. I don't care what the pundits call it. Froth, hype, mania. The math says these miners are trading at 1/3 of what they should be, just to hit normal historical pricing. And when they do catch up, I'm not sticking around for the final tick. I've been in this game too long to think the move lasts forever. I'll exit when things overheat, when RSI hits 90, when everyone on Twitter is asking if they're too late. That's the sell zone. But we're not there yet, not even close. Right now, we're in disbelief territory. The skeptics are loud. The narrative says metals are outdated. The smart money is chasing AI or crypto or whatever's trending. That's exactly where I want to be. Early, quiet, patient. Let me summarize all of this in 3 lines. Silver sits at $91. The miners are still stuck in the 30s. That gap is being held open by tomorrow's options expiry. Operating leverage says this is the most undervalued group in the entire macro market. The numbers are screaming. The price is lying. And tomorrow, paper games meet physical truth. Now let's zoom out. This isn't just about a single day of volatility or a calendar event. This is about a shift that's been slowly building for years and finally starting to crack wide open. Let's talk history. Go back to 2010-2011, the last major bull cycle in precious metals. Silver went vertical. But the miners? They lagged for months. Then one day, out of nowhere, they exploded. We're talking 2x, 3x, even 10x moves in a few weeks. Some juniors gained over 1,000%. That's not hype, it's in the data. And here's the takeaway. The miners always trail, always. Funds rotate slowly, analysts update slowly, and retail, most don't even know these tickers exist until the run is halfway done. But once they do catch up, it's fast, brutal, and across the board. That's the move I'm preparing for. Last month, December 2025, silver climbed 15%. The miners, just 2%. The gap grew. It became a canyon. If silver can hold 90, which I believe it will, then the math says miners should be trading at 3x current prices. That's not hype. That's fair value based on historical profit margins, based on past bull cycles. A 3x move puts us somewhere around, well, I'm not going to toss out specific price targets. This isn't a pump, but you can do the math. Look at where these companies traded back in 2011 when silver hit $50. Now extrapolate to today's $90 environment. The result is uncomfortable because it says current prices aren't just undervalued. They're completely, laughably broken, and I stand by that. I know what some of you are thinking. If this setup is so obvious, why isn't everyone talking about it? Why isn't CNBC covering it nonstop? Why aren't the big institutions flooding in? Fair question. Here's the answer. First, the narrative. Right now, the prevailing story in financial circles is simple. Gold and silver are only useful as inflation hedges, and inflation, supposedly, is no longer a problem. The Fed is winning. CPI is trending lower. Everything seems stable. So the logic goes, why buy silver when you can chase Nvidia, Tesla, or whatever the latest AI darling is? That mindset is sticky. Narratives take time to flip, and by the time they do, the window of easy profit is long gone. Second, the institutions are cornered. A lot of large funds and banks are sitting on short positions in these miners, positions they've held for years. These trades made sense when silver was at $20, but at $90, they're bleeding. And short positions come with inertia. If you're short and the price rises, you have two choices: cut your loss and cover, or dig in, add to your short, and hope it reverses. Guess which option most traders pick? They double down. They fight the trend, they toss more capital into a losing position. And when they're finally forced to unwind, the upside explosion is even more violent. Third, the media blackout. I've said this before, but it's critical. Financial media is not built to give you an edge. They sell ads. They chase headlines. Right now, metals are boring. No hype. No rockstar CEOs doing live streams. No meme armies hyping silver miners on social media. So they don't talk about it until the move becomes so big, so undeniable, that they're forced to cover it. But by then, the retail investor is too late. That's how it's always played. So when I look ahead to tomorrow, January 16th, options expiration, I don't just see noise. I see a potential trigger, the event that cracks the pressure system wide open. The day the suppression stops working, the day the market is forced to reprice these equities to reflect reality, not narrative. Here's what I'm doing tonight. I'm going over every position, checking my stop levels, making sure I've got cash ready, dry powder, in case the market hands us a gift, a flash drop to $85 or even $80. Because if that dip comes, I'm going in heavy. Call it what you want. Backing up the truck, loading the boat. I'll be buying with both fists, but I'm also ready for a slow burn. Maybe we just grind up, maybe $90 holds, maybe the miners climb steadily week by week. That's fine too. I've got time. I've held this trade for years. I can wait, but tomorrow is different. Tomorrow is the stress test, the release valve, and I want to see which way the pressure blows. Here's something the market taught me the hard way after 12 years in commodities. Just when you think you've got it figured out, just when you're confident, the market reminds you who's boss. It humbles you. So no, I'm not pretending I know the future. I'm not claiming to have perfect insight. All I'm doing is reading the data. And the data says this: silver miners are criminally mispriced relative to spot silver. Now, before I wrap this, I want to circle back and address one more objection, the final bear argument. What about geopolitical risk? A lot of mining operations are in unstable regions. Mexico, Peru, Argentina. Governments can change the rules. They can raise royalties. They can nationalize mines or create new environmental hoops. That's a real risk, no doubt. But that's also why these stocks are cheap. That fear is already in the price. So when those nightmare scenarios don't happen, when the mines stay open, When profits keep flowing, stocks reprice fast. That's the opening. And here's something the bears often miss. Not all jurisdictions are the same. Treating every miner like it operates in the same environment, that's lazy thinking. Mexico, Peru, Nevada, some of the best performing miners in this cycle are based in what we call Tier 1 jurisdictions, places like Canada, the US, and Australia. Stable, resource-friendly, strong legal systems. Sure, labor is more expensive, sure, permits take time, but you get predictability, rule of law, enforceable property rights. And here's the kicker. At $91 silver, even high-cost producers in expensive regions are raking it in. The profit margins are so wide, it hardly matters if you're paying Nevada wages or dealing with British Columbia regulators. You're still printing cash. Just last week, I reviewed financials from a mid-tier miner in one of those high-cost regions. Their AISC sits around $42, well above the industry average. They operate in a developed, highly regulated jurisdiction, and yet at $90 silver, their profit margin is 53%. Let that sink in. 53% margins in a so-called high-cost country. So when someone tells me they won't touch mining stocks because of jurisdictional risk, I know they haven't actually done the math. They're recycling old arguments from 2012, back when silver was $28 and margins were thin. That world no longer exists. The pricing regime has shifted, the math has shifted, and the risks that dominated in a low-price environment simply don't carry the same weight when silver trades at these levels. That's what the market isn't seeing, and that blind spot is exactly where opportunity comes from. Another common objection, declining ore grades. The argument goes that mines are getting deeper, or quality is falling, and it's becoming harder and more expensive to extract silver. And yes, that's a legitimate issue. Ore grades are declining. Every year, the easiest deposits are depleted. Producers have to dig deeper or process more rock to get the same output. But here's the key point. That's a slow, structural trend. It does not explain why mining equities are priced as if silver were still $30 while spot trades at $91. It doesn't justify today's valuation disconnect. Sure, over the next decade, AISC will likely creep higher, but silver itself is likely to rise faster. The macro forces pushing silver upward, currency debasement, central bank accumulation, persistent supply deficits, are far more powerful than the cost pressures miners face. And in the near term, the next few months, none of that long-range theory matters. What matters is the re-rating, the realization that these companies are generating enormous cash flow at current prices. All right, one last skeptic argument. And this is the big one. The banks will never allow it. This is the ultimate conspiracy claim that JP Morgan, Goldman, the Fed, someone behind the curtain, will always suppress prices and prevent silver miners from reflecting true value. And look, I understand why people believe this. There's a long, documented history of manipulation in precious metals markets. Fines have been paid, whistleblowers have come forward, lawsuits have been settled. I'm not naive. The game is tilted. But here's what I also know. Even rigged systems have breaking points. Manipulation has limits, because at the end of the day, physical supply and demand are real. And when paper markets drift too far from physical reality, something snaps. That's what I believe we're watching right now. The paper market, futures, options, ETFs, is signaling suppression. The physical market, refiners, mints, vault operators, is signaling shortage. And tomorrow, January 16th, we find out which one wins. So let's bring this back to execution, my personal plan for the next 24 hours. Tonight, once I'm done recording, I'll review every position I hold. I'll double-check my stop levels, loose enough to survive volatility, tight enough to prevent real damage if I'm wrong. Tomorrow morning, I'll be watching from the opening bell. I want to see how silver opens. I want to see whether miners gap higher, lower, or flat. If we get a repeat of this morning, a sharp drop followed by a fast recovery, that tells me suppression is still active. But the floor is strengthening. If silver rips higher immediately, if we gap up and hold, that tells me control has broken and short covering is underway. And if we see a slow grind lower, if $90 breaks and we drift toward $85, that tells me patience is required. The thesis isn't invalid, but the timing is off. Around 1 p.m., heading into the final OPEX window, I'll be locked in. That's when the real action starts. That's when market makers pin prices to maximum pain. That's when the head fakes and violent swings appear. After the close, once the dust settles, I'll assess the damage. Where did we finish? What was the volume? How much open interest expired in or out of the money? Then I'll decide what Monday looks like, because the real move happens after OPEX. That's when hedges unwind. That's when gamma pressure disappears. That's when the true trend can reassert itself. If we close above $91 and SIL shows relative strength, I'm adding Monday morning, early, before the crowd catches on. If we close below $85, I'm stepping aside and waiting for confirmation. And if we close in the messy middle, no clear signal, I'll do nothing. Because sometimes the best trade is no trade. Sometimes discipline means waiting. That patience, the ability to wait for your pitch instead of swinging at everything, is what separates survivors from casualties in these markets. Now let me address something I know some of you are already thinking. Why should I believe you? You're just a guy on YouTube using an AI avatar. How do I know this isn't all nonsense? Totally fair. You shouldn't take my word at face value. You shouldn't take anyone's word at face value. But here's what I can offer you. I've been in these markets for over a decade. I've seen bull runs and brutal crashes. I've made great trades. I've made painful mistakes. And one thing I've learned repeatedly is that the market doesn't care about your ego, your credentials, or your follower count. The only thing that matters is price. And right now, price is flashing a serious signal. I launched this channel because I have access to tools most retail traders don't. I watch Bloomberg feeds in real time, I monitor vault deliveries, I track institutional flows, and frankly, I got sick of watching financial media get it wrong, or worse, twist the story to fit their advertisers' needs. That's why I use this avatar. It's fast, no waiting on production teams, no gatekeepers, no fluff, just raw data, real-time charts, and honest analysis. And if I'm wrong, if tomorrow silver dumps, miners collapse, and this thesis falls apart, I'll come back here and say it. I'll show you what broke down, where I misread the signal, because that's how trust is built. Not by acting like you're always right, but by showing your work and owning it when you're not. Now let's zoom out. Because silver miners don't operate in isolation. They're one piece of a much bigger macro puzzle. Right now, we're in a weird, contradictory market. Tech stocks are pushing new highs. The S&P is within striking distance of records. Meanwhile, gold is sitting above $4,000. Silver is trading over $90. Risk-on and risk-off assets are pumping at the same time. What does that mean? It means investors are hedging in every direction. They're buying stocks out of greed and metals out of fear. That's not stable. That's not normal. Something's going to break. Either stocks roll over and metals explode as the safe haven, or the Fed somehow sticks a soft landing, inflation stays tame, and metals cool off. But there's a third outcome that almost no one is talking about. What if everything keeps going up? What if stocks keep drifting higher, and metals do too? Not because the assets are stronger, but because the dollar is weaker? What if we're entering a period of broad, nominal gains across all assets, while purchasing power quietly erodes? That's the environment I'm preparing for. Silver at $150, gold at $6,000, tech hitting new highs, and your dollar's buying less every year. In that world, miners become a powerful asymmetrical play. They're tied to silver's upside and their equities, so they also ride the equity wave. That's why tomorrow matters, because tomorrow might be the first real crack in the suppression wall, the first sign that reality is about to punch through. Let me give you one final piece of history before we close. Back in 2008, during the financial meltdown, silver collapsed. It fell from $20 to $8 in months. Miners got slaughtered, some down 90%. But by 2010, silver had surged to $50. And the miners? They exploded. 3x, 5x, even 10x in some cases. That's not a fantasy. That's on the charts. Go look. These markets are violent, they're cyclical, they punish the impatient. But if you can stomach the ride, if you wait for your moment, the payoff is huge. And I believe we're in the early stages of that exact same pattern. We've seen the shakeout, the disbelief, the media silence, the institutional shorts. Now, the breakout is forming. Tomorrow is the test. Tomorrow, we find out if this is real. Here's your 3-sentence recap. Silver is trading at $91, but miners are priced like it's still 2015. That gap is being held open by tomorrow's massive OPEX unwind. Operating leverage makes miners the most mispriced sector in global markets right now. The numbers make sense. The prices don't. Tomorrow is when paper games collide with physical reality. Things are moving quickly. If you want to understand how this suppression machine works from the inventory side, if you want the vault data, the COMEX mechanics, go watch my full breakdown on the COMEX squeeze. I'll be watching the action tick for tick tomorrow, and if we get the breakout I'm expecting, I'll be back here with an update. Until then, stay sharp, stay patient, and stay focused. Don't let the noise drown out the signal. The opportunity is right in front of you. The math is solid, the setup is built, now it's just a matter of whether the market agrees. Stay frosty.